Kitco News, special coverage of the Precious Metals Summit, is brought to you by Corvus Gold.
We're here with Ronald-Peter Stoeferle, managing partner of Incrementum AG. Ronnie, welcome to the show. I've been looking forward to this interview all week.
Hi, David. Good to see you in person for the very first time.
Absolutely. It's a pleasure. Absolute pleasure. I had the pleasure of watching your presentation yesterday. Fantastic presentation.
Thank you.
Talked about your macro outlook and what it means for gold, and we'll talk about the monetary tipping point that we're in right now, a very exciting theme. You also publish the In Gold We Trust report once a year. Massive book, here it is, and it's free for everyone to access,
Absolutely.
right? Yeah, where can we go to find the report?
InGoldWeTrust.report.
Okay, congratulations.
There's not only this very big, extensive version, there's also a compact version available in English, German, and Mandarin.
Well, congratulations on the report.
Thank you.
Okay, so one interesting part of your presentation that stood out to me was that you talked about a friend of yours who told you that gold is dead. And I sympathize with people who may have that view right now, because you talked about the three functions of gold that gold should have. One is to protect against inflation, one is to protect against recessions, and the other is hedging against equity volatility. And we'll be talking about all three things. If you look at the data, if you look at just the last 18 months, let's break it down. Has it hedged against equity volatility? Yes, in some regard, but if you look at the past major equity decline in March 2020, at the outbreak of COVID, gold went down with equities like everything else. If you look at recessions, yes, again, it went down during the start of the recession, then it climbed up after the recession technically was over, according to data. And rising inflation, well, did it really protect against inflation? Objectively speaking, no, because we've had higher inflation this year and higher inflation expectations while gold stagnated. So given these three things, how would you respond to your friend that gold is dead? Do you agree, disagree?
Well, he gave me this reply when we talked about the price of gold, and he asked me, what do you see? And I said, well, at the moment, sometimes I don't really 100% understand gold. But I said, the sentiment is already that negative, then it can go to new all-time highs within a couple of months, actually. So we're not so far away from it yet, $270. And I think his reply, and he was definitely, I would say, diehard gold bug. He said, no, that's absolutely impossible. Gold is dead. So that showed me from a kind of contrarian point of view that already in the gold industry, there's so much pessimism, which is for me a pretty good sign, I would say. Now, coming back to your points regarding those three hedging functions, we crunched the numbers and we wrote more than 3,000 pages of research about gold. And I think that gold reacts very, very early on in a stage. So actually we once did a presentation called the gold, the seventh sense of financial markets. So gold is basically sniffing out when there is something coming. And in the course of the recession, for example, we should not forget, we said in 2019 already, when gold was up 18% in dollar terms, we said that a recession is coming because of the yield curve, because of most economic numbers coming in much weaker. Of course, we didn't know that COVID was the trigger, and obviously it was more than just a normal recession. But I think that the recession clouds were already getting darker. Now gold already discounted that, and then last year, 2020, gold was up 25% in dollar terms. Yes, in those times when it was really volatile in spring, gold was down initially. A bit like in 2008, 2009, but I think that gold reacts very, very quickly because it anticipates future monetary and fiscal stimulus. Because every time, of course, there's turmoil in financial markets, what's going to happen? There's going to be, the monetary floodgates, the monetary gates are opened, and there's fiscal stimulus. So gold reacts to that very quickly. Does gold work as a recession hedge? Yes. We crunched the numbers in our last year's report, and we said, well, there's actually different stages of a recession. Normally, the recession is officially announced when basically the worst is already over. So gold acts in the first three stages of a recession. Before it is officially announced, it works very well, and then actually the equity markets are performing better than gold. And coming back to inflation, the third hedging function basically of gold, I think that last year gold already sniffed out that this fiscal stimulus will lead to higher inflation numbers. Okay. I think at the moment why gold is acting a bit frustrating for many people, also for me, I think the reason is that the market at the moment believes that inflation is only transitory. My case that it's not transitory, and we'll see who's right.
We'll talk about that in detail when we talk about your monetary tipping point thesis here. I want to ask you whether or not cryptocurrencies have played any role in gold's underperformance this year.
Well, we are very open to cryptos. We in fact manage 2 funds that combine gold and gold mining stocks with Bitcoin and other cryptocurrencies. So from my point of view, they're not really a competitor or an enemy of gold. I see it as complementary. So I think from a portfolio point of view, it makes sense to combine both. I think, of course, gold for the media, for example, I think Bitcoin stole a bit of media attention. Yes. From gold, because there was so much going on, new all-time highs, lots of volatility, and of course it is something that is discussed in a very controversial way. Yeah. You either love Bitcoin or you hate it. There's really nothing in between. So yes, perhaps when it comes to the media, but I think when it comes to flows, I don't really see it, because I think at the moment, if you analyze the buyers of gold and also of crypto, I think there's not too much overlap. Okay. I think what's really missing for gold at the moment is investors' demand. And if you have a look, for example, at ETF flows, they are very pro-cyclical. So every time gold rises, there's money flowing into these ETFs. Every time gold falls, money is flowing out of those ETFs. And I think that as soon as gold will pick up momentum, I think investment demand will kick in again. And I think this will be the major driver for gold going forward.
These 2 asset classes, cryptocurrencies and gold, do they have any overlap in terms of the type of investors? Just in your funds, for example, do people buy both your precious metals funds and your crypto funds? Or are they different groups of investors?
But I think we are one of the very, very few companies that actually combine both. Okay. My partner Mark and I, we started thinking and also investing in Bitcoin in 2012. I think it's a extremely interesting scene. I've met brilliant people in this industry. I think, it is something completely new. So there's so many different aspects to analyze. For example, what's going on in El Salvador at the moment. Yes. Yeah? That's a very, very big monetary experiment. Yeah? I don't know how it's going to turn out, but I think it's extremely fascinating to follow. Right. So from my point of view, there are many similarities. I think the stock to flow ratio, so this natural inflation of gold and of Bitcoin is very similar. I think both are hedges against, all those big monetary experiments that are going on. They're hedges against fiat money. They are there to preserve your purchasing power, and therefore I think both fit into your portfolio. But as I've said, we're one of the very few asset management companies that actually combine both.
So you don't think Bitcoin competes with gold as a store of value?
Not yet. Perhaps at some point. And when you compare market caps, gold is at 10 trillion at the moment, Bitcoin at 8 or 900 billion. So it's still tiny compared to gold. Of course, it's catching up. But I think what we're now really seeing is this mass adoption coming from big institutional players. So it used to be back in the days, mostly tech savvy, younger people, very much of retail driven. And now is really the stage when institutional players are coming in. And obviously this is going to be the main driver going forwards in the crypto space. Yeah. So, yeah.
One more question on crypto, and we'll go back to the markets. I've talked to some crypto investors and analysts, and people talk about the flippening of gold. So like you said, Bitcoin is only a very small percentage of the gold market cap. We're talking about $9-10 trillion, depending on what the market price is. And Bitcoin is less than $1 trillion, depending on what the price is. So one day, they say, it will flip gold. Do you agree?
I don't think so. I think it will catch up. my long-term price target for gold is $4,800. So there's, I think that the market cap of gold will continue to rise. But
you don't think Bitcoin will grow at least 9 times?
I think if Bitcoin will be around in 5 to 10 years, I think prices will go to regions that we cannot imagine at the moment. Absolutely, because if you really see it as a hedge against inflation, against those big monetary experiments going on, and if you compare it, I don't know, to the size of the real estate market, to the bond market. Yeah, at the moment there's 19 trillion invested in negative yielding debt. So I think there's lots of catch-up potential. But I made the comparison once. It is like having in your garage a big Volvo SUV, very comfortable, and a Ducati Panigale, so a really, really fast motorcycle. And you can go from A to B with both.
Yes.
It's going to be probably more fun on the motorcycle, but it's also more risky.
Yes.
So, and as soon as it starts raining or snowing, it's going to get really risky. So, you just have to choose if you can stand the volatility of Bitcoin.
Does Bitcoin protect against rain and snow, so to speak? Does it have the same hedging functions as gold when it comes to recessions, falling equity prices, and so on?
Well, of course, I mean the time frame to analyze that is not very long, but we saw last year during the COVID crisis that Bitcoin got hammered. Yes. So I think it does have some sort of a risk on function, so it works best in a risk on environment, but that doesn't necessarily have to mean that it's going to be always like that. So perhaps in the next market crash, people will turn to Bitcoin. Yeah. Yes. So I could definitely mention that.
Interesting. Let's talk about the monetary tipping point. In your presentation, you opened with a slide of a picture or a video clip of a warehouse, and there was a lift fork, and you had an accident, and the entire warehouse collapsed onto the lift fork. And you made that analogy comparing it to today's financial conditions. So why are we at a tipping point, and what exactly is this tipping point?
Well, the tipping point, it goes back to this fantastic book by Malcolm Gladwell. And I made the analogy because I think basically since the end of the Great Moderation, and I would say that the Great Moderation, so basically those decades when inflation was under control, where we saw very steady growth, I think that the times of the Great Moderation are over. And since the great financial crisis, 2008, 2009, central bankers are really desperate trying to reach higher inflation numbers. So basically, since 2008, they keep telling us inflation rates are too low. We have to print more. We have to do more quantitative easing. We have to lower rates for longer to get inflation rates up. Now, I think the COVID crisis was really the tipping point because we saw very, very high monetary growth. M2 was up 25%. And by the way, gold was up 25% last year as well.
Coincidence?
I don't know. Yeah, I don't think so. But now we're also seeing very aggressive fiscal stimulus. And I think this combination that really, really led us to this tipping point. And we're seeing it, of course, listening to central bankers. They keep telling us that inflation is transitory. They say, well, it's going to come down significantly. From my point of view, it's not transitory because of lots of new policies, mostly fiscal policies, that are now being introduced additionally to central bank policy. And I made the case, I said, perhaps the big days of central banking are over.
Yeah. And you made the case that central banks are losing their way in terms of doing their job. They're starting to get involved with politics. They're starting to become social activists, you said.
I think, yeah. I think it's interesting that, for example, the ECB, if you listen to them, which is not so easy because,
yes.
They sometimes sound like, I don't know, Greenpeace activists, yeah, because they now want to fight climate change. And that's my view.
Is that the central bank's role to?
It is not their mandate.
Yeah.
It's not their mandate. It's also not my job to, I don't know, to dance ballet, whatever. Yeah. So and if you listen to Jay Powell, for example, it's much more about the labor market and the inequality in the labor market. So it seems that they're really trying to work in kind of new fields that give them more leeway to stay dovish for longer. I think that's the main reason. But I think that since last year, basically we saw that fiscal stimulus is taking over, and I don't think that politicians will give back this too soon.
Talk about fiscal stimulus just a bit. Do you think politicians are infiltrating the central bank and becoming more influential in monetary policy than maybe they should be?
Well, of course.
Do you see evidence of that?
Officially, they are independent.
Yes.
I'm not so sure, and I mean, I read a couple of books about what's going on behind the curtains. There's a great book called 3 Days at Camp David. So what happened before 15th of August 1971, and we saw that Nixon was applying great pressure on Arthur Burns, the former head of the Federal Reserve back then. And I think, it all has to do obviously with the debt situation. In the Eurozone, for example, can we really let interest rates rise significantly? I mean, we didn't see any rate hike at all. Mm-hmm. Compared to that, the Federal Reserve was doing a fantastic job. It's just not possible. So the higher the debt levels, the greater the sensitivity to rising interest rates.
That's right.
And obviously, the debt levels were already high before the COVID crisis.
Yes.
And now all taboos were broken. So we mentioned this frugal Swabian housewife. So the Germans were always known to be, against deficits, and mm-hmm. they really did a good job over the last couple of years. But now it really seems that those taboos are broken and that austerity is out. And in that environment, from my point of view, it's basically impossible to let interest rates on a nominal basis. So I think on a real basis, we will see negative rates for the next couple of years. On a nominal basis, perhaps they'll rise a bit, but definitely less than inflation rates.
Yeah, let's talk about inflation now. Is that the reason why you think inflation is not transitory right now or going into the future? You made a pretty scary quote in your presentation. You said that 2% inflation used to be the floor. Sorry, it used to be the ceiling target. Now it's the floor.
There's talking about that. There's not too many ways to come out of that situation, and obviously inflation is kind of the most convenient one. I don't think that we're gonna see a default. I don't think that we will grow out of this situation. So it will be financial repression. I think at some point we will see some sort of a yield curve control. In combination with higher inflation rates. I think that's basically the playbook, and I always said that, and now it's happening, and people tell us, well, it's only transitory. I don't think so.
If you look at a CPI chart, and you have a chart of that in your presentation, the long-term chart of U.S. CPI, you'll see that whenever we've had spikes in the past, for example, the early 80s, it's gone up very aggressively, but it's also come down very aggressively. We did not see inflation plateau around the double digits for more than many years, mm-hmm. several years at a time. Obviously, back then, Volcker was very aggressive in lifting interest rates, but it goes back to Jay Powell's point about transitory inflation. Objectively speaking, if you looked at high inflation in the past, it has been transitory, lasting no more than a few years at very high levels. So do you think even we're seeing a spike now? Is that going to be the same kind of shape, you think? It'll go up and then it'll go back down? Or do you think it'll go up and then sort of just plateau at around 5-6%, 7-8%? That'll be the new normal for us?
I don't think that 7-8% hopefully will be the new normal, but I can imagine that we'll be at 4 to 5% over the next couple of years. And this in combination with zero interest rates, that's pretty negative real rates. And from my point of view, if you compare it to Volcker, for example, I mean, his job was to kill inflation after the highly inflationary or stagflationary in the 1970s.
He didn't have $30 trillion of debt on his books, though.
Exactly. It was a completely different situation. But I think it's important that now we are also seeing new policies being introduced like average inflation targeting. So this gives basically the Federal Reserve and now also the ECB the leeway to say, okay, inflation rates were undershooting over the last couple of years. Now we can officially let it overshoot over the next couple of years. So I think this is a pretty dramatic change. And since it was introduced in August 2020, inflation expectations are on the rise. So it's kind of working.
Yes, inflation is going to beat deflation is one of the themes of your presentation. There's several economists who believe in the deflation story, how we're slowing down as an economy. COVID had a part to play in that. We're going to see deflation. Do you disagree with that? Why?
I think there's still lots of deflationary forces. And I think, if there would be some sort of a laissez-faire approach, we would see massive deflation. But within our monetary system, we just cannot deflation let happen. So I think there's lots of deflationary factors like technology obviously. I think that we would at some point have to see a recession, which is also always deflationary. But now Federal Reserve and politicians try to fine-tune the cycle and avoid every recession. From my point of view, a recession is something normal, something healthy for the capital structure and for it's called a cycle. But if you avoid this downturn in the cycle, it's just gonna get worse. And you have this zombification that we're now also seeing in corporates, for example. So to answer your question, David, sorry, I think that the deflationary forces are still here, but I think that the pendulum is now swinging into the deflationary area. So inflationary forces are now really stronger than deflationary forces.
Why do you think central banks target 2% inflation? Why don't they target 2% deflation? Wouldn't that make our standard of living better if the next year the cost of living is lower?
Well, that's the main argument.
That's a simplistic way of thinking about it, of course. But
when we've got deflation, so falling prices, people stop consuming. So that's a narrative. We all know that it's nonsense. Because prices are coming down for cell phones, for most technological things, and people still buy it because they want to have it. So from my point of view, if you're highly in debt, obviously deflation is the last thing that you want. You need inflation. So, and the higher the debt levels, the higher the desire for inflation, obviously.
So this is by design. They want inflation, they need it.
Exactly.
Okay. You made an interesting point how fiscal dominance is more important than monetary dominance. You compare fiscal policy to Opranomics. Everybody gets money.
Well, that's not my analogy. That's by Nordea.
Okay.
But I think what really changed over the last couple of months is that now we are going direct. So we are seeing those direct subsidies. People are getting their money from the government on their bank accounts. We're seeing that MMT and kind of MMT-like policies and helicopter money kind of policies. It used to be, before the COVID crisis, it used to be really ideas from left-wing economists. Now it's mainstream, and it's happening. And I think that stuff like universal basic income will be introduced. I think that CBDCs will be used to transfer every time we are seeing a downturn in the economy. It will be used to stimulate the economy again. And this, compared to quantitative easing that we've seen since 2008, 2009, which is basically an asset swap and fuels asset price inflation, I think those Opranomics, or however you want to call it, policies are having a much faster and much more direct impact on the economy and on inflation.
Actually, is CBDCs going to be part of M2? Do you know? M2 money supply?
That's a very good question.
Because otherwise it's just going to...
I don't know, but the calculations of monetary aggregates, they are...
because they are creating new money when you think about it. It should be considered part of the money supply.
Yeah. Should be, but
we'll see. Okay, so let's go back to gold now. The three functions of hedging we'll talk about. But do you think there's going to be another recession coming up, another stock market crash, and we talked about inflation, of course.
Well, a recession might be on the horizon. On the other hand, so we are seeing, Atlanta GDP now indicator basically is down 50% since in the last couple of weeks. So now I think we're at 3.5%, something like that. And most of the economic numbers coming in are weaker than expected, significantly weaker than expected, and also obviously has to do with the COVID situation that is unfortunately not really under control, at least in Europe. And it seems that we will see at least partial lockdowns in fall and winter again. So is a recession on the horizon? Perhaps, but what I know is that as soon as the recession clouds get darker, central banks will become more aggressive again. We saw that already with tapering being kind of postponed. I think at some point it's going to happen. I hope it's going to happen, because this whole discussion, when will tapering starts, it kind of bugs me, because it's a stupid discussion. It's like the alcoholic saying, well, in 1.5 years I'll drink 1 glass of whiskey less. But it shows you a lot, and it shows you how dependent markets nowadays are on central bank policy. But one of the main takes, or one of the main things that I wanted to present and communicate yesterday, perhaps we should focus less on central bank action and more on fiscal action. I think that's really the way to go going forward.
Stock market volatility. We're at new all-time highs every single day, pretty much.
Yes.
Can this last?
It's like a party that is already crazy, and you say, when
will the police come?
But then there's always after parties. So, and if there's illegal substances involved, it can go much longer. So honestly, we all know that in certain areas, valuations are crazy. It is not only in equity markets, obviously. We're also seeing it in real estate. We're seeing it in the art market. We're seeing it obviously in the crypto space. We're seeing it in all sorts of different markets. So, based on the Austrian School of Economics, this feels a bit like a so-called crack-up boom.
Yes.
Where people kind of lose confidence in the future purchasing power of money, and they just want to get real assets.
Right.
So, but then normally gold should do very, very well. And this is obviously the big question that I'm asking myself. What is the reason? And I don't know if I have good answers, perhaps.
Well, let's just narrow down on one specific variable: inflation expectations. We know you think inflation expectations will go inflation itself will go even higher. The market agrees with you. Inflation expectations have been going higher. We talked about the TIP, the Treasury Inflation Protection Security offline. And if you look at the graph of the two variables, traditionally they've had a very close correlation, up to 97%, if you look at the past 5 years of data. Recently, they've diverged. Why do you think that is?
Well, we could say the correlation is indeed very high. We could say, who's wrong? Is it inflation expectations? Perhaps they are too high. It's not my case. Or perhaps we're seeing that the price of gold will catch up with inflation expectations. So from my point of view, I think that the market is now seeing, well, inflation is a concern, but not for the long term. So the market is discounting, well, inflation rates have risen for the shorter term, but longer term they are indeed transitory. But from my point of view, they are not, and we're already seeing this wage price spiral that starts to spin. So therefore, I think that gold, being one of the most reliable inflation hedges, should catch up. And this in combination with the sentiment that is already pretty weak, I think that's a pretty good setup. And we should not forget, we shouldn't get too greedy, David. I think many people tend to forget gold was up, I think 18% 2019, 25% in 2020, and year to date in dollar terms, it's down 3.5%. It's not that bad.
Exactly.
And I think the job of gold is not to make you rich. The job of gold is to preserve your purchasing power. If you want to get rich quick, buy junior mining exploration stocks. And we saw some fantastic stories out here by cryptocurrencies, for example. But gold's role is really to protect your purchasing power, and I think it's done its job pretty well.
I think some people, like your friend, may be disheartened with gold, not because it's only gone down 3%. It's really nothing in terms of a decline. It's because, like we discussed, maybe it hasn't fulfilled its role as an inflation hedge as well as it should have. So let's go back and wrap it all up. Given everything we've discussed, is your friend right? Is gold dead?
I don't think so.
You don't think so? Well, you think it's going to $4,000, so.
$4,800 that's the price target that for the end of this decade.
Yes.
Not the end of this year.
No, okay.
That would be
Thank you for clarifying.
No, we based it on our model that is basically, we kept it pretty simple because I used to work in a bank and we had very, very complex models that didn't work. So we said, okay, what really counts? It's monetary growth and also trust basically in the currency and the gold backing of a currency. So the so-called shadow gold price. So we calculated it, made some regressions, and we came up with the most realistic target by the end of this decade of $4,800, which sounds like a lot, but that's 13% on a CAGR basis, to compound annual growth rate. So, well, is it possible? From my point of view, if inflation becomes a concern, definitely.
It's 2 times what we are currently, more than 2 times what we are. Gold has climbed more than 2 times, and if you look at the past, if you look at the 2011, for example, peak, it's climbed more than 2 times over the 10-year period. So
exactly.
Ronald, thank you. Ronnie, thank you so much for being here.
Thank you very much, David. It was a great pleasure.
Thank you.
Excellent interview. Thank you.
Thank you, David. Thanks.
And thank you for watching Kitco News. I'm David Lin.
Kitco News special coverage of the Precious Metals Summit is brought to you by Corvus Gold.